Interest rates are one of the most important forces in the economy. They affect the cost of buying a home, financing a car, using a credit card, borrowing for a business, and even the return you may earn on savings. But what exactly is an interest rate? Why does it change? And how can a simple percentage affect so much of the economy? At its simplest, interest is the price paid for using someone else's money. When you borrow money, a lender gives you access to money today in exchange for being repaid in the future. The interest rate determines how much that borrowing costs, usually expressed as a percentage. For example, borrowing $1,000 for 1 year at a 5% interest rate would cost $50 in interest. Interest also works in the other direction. When you place money in certain savings products, you may earn interest, so interest can be a cost to a borrower and a return to a saver or lender. Lenders charge interest because they give up the use of their money and take the risk that it may not be repaid in full. Inflation can also reduce future purchasing power. Interest helps compensate lenders for the time, risk, and potential loss of purchasing power involved in lending money. There is no single interest rate for everything. Mortgages, credit cards, auto loans, savings accounts, and business loans can all have different rates. Factors such as risk, loan terms, inflation expectations, market conditions, and monetary policy can influence those rates. This brings us back to the Federal Reserve. As we learned in the previous episode, the Fed uses monetary policy to influence financial conditions. One important part of that policy is the federal funds rate, a key short-term interest rate within the banking system. The Fed establishes a target range for this rate and uses its tools to help keep it within that range. The Federal Reserve does not directly set the interest rates that most consumers and businesses pay. Those rates are determined by lenders and financial markets, but Fed policy can strongly influence them as changes spread through the financial system. When rates rise, borrowing becomes more expensive. Mortgages, auto loans, credit cards, and business financing may cost more. Households may postpone large purchases, while businesses may delay investments. Across the economy, this can reduce spending and cool economic activity. Higher rates can also benefit savers. Banks may offer higher returns on certain savings accounts and other interest-bearing products. This means savers may earn more interest on their money, making saving more attractive. When rates fall, borrowing can become less expensive. Households may be more willing to make large purchases, while businesses may invest and expand. This can strengthen economic activity, although returns on some savings products may decline. Interest rates are especially important in housing. Even if a home's price stays the same, a change in the mortgage rate can significantly change the monthly payment. This can affect the demand for homes and what buyers can afford. Businesses and investors watch rates closely. Financing costs can affect business decisions, while changing rates can influence stocks, bonds, real estate, and other investments. Financial markets may react to where interest rates are expected to go next. Interest rates also play an important role in inflation. When inflation is too high, higher rates can discourage borrowing and spending. Weaker demand can reduce some of the pressure pushing prices upward. When economic activity is weak, lower rates can encourage borrowing, spending, and investment, helping support the economy. But interest rates are not an on and off switch. Higher rates do not automatically stop inflation, and lower rates do not automatically create economic growth. Their effects take time, and many other forces influence the economy. That's why high rates are not automatically bad and low rates are not automatically good. Their effects depend on economic conditions and why rates are changing. Interest rates are ultimately the price of borrowing money and, from another perspective, the return from lending or saving it. When rates change, they influence financial decisions throughout the economy. In the next episode, we'll look at quantitative easing, or QE, another tool the Federal Reserve can use to influence financial conditions. We'll explain what QE is, why the Fed may use it, and how changes to its balance sheet can affect interest rates, borrowing, financial markets, and the broader economy. If you found this video helpful, please like, share, and subscribe to Life and Money for more practical, beginner-friendly lessons about money, investing, and the economy. Thank you for watching.